One of the most interesting days of the year by far. Technically speaking, one of the most interesting days in the last 4 years. The spread between the Russell and the NASDAQ so big. The absolute opposite of the entire regime we've gotten so used to. Everything we knew today was inverted and flipped on its head. Inflation comes in light, but also jobless claims, crucially, came in also light. It was the perfect combination. Yesterday I talked about that. The ideal combination will be jobless claims stable and solid while inflation comes in light, and we got it. So the big move was in the small caps. We pushed almost to the year-to-date highs. Okay, real close. It's incredible. 2100 has been resistance on Russell, and we just blasted through it. Today is a massive repricing in the market's eyes of the potential economic outcomes, I think. In fact, this rotation today was more than just a diversified portfolio working or an equal weight validation. This is a pretty specific espousing of a view by the market that we're not just going to soft land, we are going to immaculate land. This is a market saying we're going to be able to cut for the right reasons. And if we opened the floodgates today to regional banks, beating down solar trades, green energy stuff, the stuff that generally has been reserved for the most risky components of the market. Now, equal weight also technically had a pretty big move too, and that's important because the chart had been making this kind of sideways triangle, so a breakout here for equal weight. This is a huge technical event today, but I can't help but to shake this feeling that something is off here. It's weird. There's been too much weakness in economic data throughout the year. We've still been missing everything. The SOM rule, very close to being triggered. The general trends are bad in the economy. They're not awful because the nominal levels are still good. But the trend here still points to a slowdown. But the market's taking today's information and making it look like the slowdown can be avoided and that we're going to be able to cut for the right reasons. The catch here is that still, without July on the table and no August move, that still gives you months until September when the Fed will actually act. The bond rally today was big, but we've seen the bull steepener in bonds that looks more like something that happens when recession is nearing. Folks are tired of hearing about the yield curve analysis and the tens to the twos inversion, but it's always been the case that when they start to uninvert because the Fed has to act, that's actually when you're getting towards the later end of the cycle. Now, this is where it comes into account because KRE today had this huge move. The regional banks, if you think about them, is kind of the most risky part of the market, still the one that really needs help with lower rates through all those companies that need to refinance at cheaper levels before they run into a debt wall. That's why you look at this group, and what's interesting is in the past, yield curve steepening has not been welcomed by the regional banks. The big crash actually included yield curve steepening through the bull variety, which is what we're getting right now, because that was a scary point in the economy. So I'm worried that the regional banks are reading the message wrong, because it looks a lot like what you get when you have to act because the economy is slowing down so much. And the thing still is, even though we're celebrating the month over month, Jerome Powell's right in that they still need to see more data. There's a lot of folks saying they need to cut in July, but I think it's just a lot of economists that want to be able to look back 8 months from now and say, see, Fed, I told you you should have started to cut in July. But Jerome Powell's given no indication he's going to. So likely the data will still continue to worsen as they remain tight because he's just trying to do his job and doesn't want to look political. Can you blame him? So don't expect anything till September. That means there's still going to be tightness in the economy. And that's where today's big rotation into the cyclical stuff and the stuff that really needs the economy really makes me scratch my head. Also, don't forget technically, Nvidia too might have just got stopped out from a higher high. There's chart stuff here that really matters. Okay? This is kind of what it did back here. Similar thing before it dripped off. The rotation, while on the surface looks very encouraging, the math for the index just doesn't add up. This is the whole risk concentration. Even if you want to put aside everything I just said about the economy and disagree, what really matters most still technically is if these trends keep trending up. And you had a bearish engulfing in the S&P. You had something in the NASDAQ candle that was crazy. Look, the momentum and trend is your friend. We haven't broken it. But the fact that we finally had some fraying in the tech stuff right when we had the piece of information that should have brought us the broad rally, I maintain my view that rotation is not just unlikely, but rotation to an immaculate landing is looking very unreasonable. Also, call me crazy, but I'm still watching Bitcoin. And the thing faded again. If there's this notion that we're going to have money pour into the market all of a sudden because we're getting cuts in a firm economy, Perhaps maybe we've just realized that Bitcoin stinks and there's no use for it, or maybe it still is telling us that risk appetite is not coming back the way you think. The stock light, which has been green, is going yellow. It might just be for a day, I might regret it, but it's just too strange of a session. The spidey senses are tingling too hard. I'll see you tomorrow.